Yeah, Joseph, tell us about that. For so long we have heard when the 2 year was at 60 basis points, we heard the Federal Reserve cannot hike. It's impossible. There's simply too much debt, and the reason was along the lines of what Alf just said in terms of corporations will not be able to roll over their debt. But it seems as if at least the market now thinks that the Fed can hike. I mean, the terminal rate is at 3.9%, as Alf just showed. That is shockingly high. I think the 2 year is the highest since 2007. So, Joseph, your view that the Federal Reserve will be very aggressive seems to have played out. So, Joseph, explain why the view that the Fed just can't hike. It's impossible. There's too much debt. Explain why that might be a little bit flawed.
So I think there's a couple of ways to think about it. So when it comes to whether or not the stock of debt is too high, and that's a confusing point to me. I would divide that into both public debt and private debt. The public debt, as we know, it's treasuries, federal government. That's never a problem. I mean, well, the Treasury can always just keep on borrowing, like it's always done. Worst comes to worst, it'll just ask the Fed to buy it all, right? The private debt, I think it depends. So, for example, if you have a corporation, and yes, interest rates are going higher, what I would say is that a corporation, a real economy corporation, has a lot of costs, right? So it has wages, it has rent, it has commodities, and so the interest rate going higher, it's like wages going higher. It's one of its costs going higher, and it's not even its biggest cost if it's a real economy corporation. If it's a financial company, yeah, it's going to be interest rate costs are a big part of a financial company's expenses because a financial company just borrows a lot of money and invests. But for a real economy, it's not that I don't. It's not a big part of its total expenses. And also, you have to keep in mind that we're in an inflationary environment, so its revenues are going up as well. So that's why the concept of a real rate is helpful. It's adjust for inflation. So the real rates are still very low. So even if a company has higher wage costs, higher interest rate costs, its revenues are going up a lot as well. Actually, there's a really good chart on Fred from the Fed that basically shows corporate profits have gone basically parabolic and stayed at a very high level. So I think they'll be fine. But I think Alf makes a really good point about slowing the incremental activity because some sectors of the economy are super interest rate sensitive. Those include, for example, housing and, as Alf suggested, autos, right? So if you want to buy a home or you want to buy a car, a lot of it is going to be financed based on, let's say, medium-term interest rates. As we know, mortgage rates were 2.5% in the U.S. just a year ago. Now they're almost 6%. That's going to slow down those industries. And housing is a tremendous industry. You build a house, you have to hire a bunch of people. You need a lot of wood. You need like a new refrigerator and so forth. So that's a big part of the economy. So all that stuff is going to slow down. But I mean, just in terms of rolling over the debt for a corporation, I don't worry about that. But it'll definitely slow the economy down as it's intended to do. That's the whole purpose.
But there is a point, right, Joseph, where interest rate burden on corporates that are struggling comes to a point where they essentially become zombie companies again, right? Like, at what point do you think that is? Is it 10%, 12%? I know that high yield now is up at like 7% with the risk free essentially at 3%, and then the spread on top of that 4% ballpark. So if the high yield companies now they have to when they borrow, they used to pay essentially zero, or 2%, something very super low. Now they pay 7 if they want to refinance. At what point do you think it becomes a problem?
I'm not really sure because it also depends, remember, on the level of inflation. Because even if when interest rates go higher, that suggests that all the prices going higher, so the revenues are increasing as well. There's actually been a study from the Fed just I think 2 months ago, okay, 3 months ago, on zombie companies in the U.S. and they found that it wasn't a very high percentage. Now I know there are people on Twitter who have charts showing that there's tremendous amounts of zombie companies floating around in the U.S. But I don't really know what's more accurate there, the Fed's research or what I see on Twitter. But listen, we have extremely low interest rates. We're going to go a little bit higher. I would be surprised if just going, let's say, from 2 to 4%, and suddenly these companies just have to go out of. A lot of companies have to go out of business.
Alf, if you have more to say on that, definitely feel free to say so. But I've got a question, which is Do you think that the 2-year Treasury yield at what is it, 3.3% now, is it a buy? I know for a long time, like Joseph, you've been wary that Fed hawkishness or perceived hawkishness would continue those implied rate hikes. But we're at 3% now. The terminal rate's at 3.9. We're breathing some pretty rarefied air in the fixed income market. So is it time to sort of buy the dip in the short on either end of the yield curve, the short end, the long end, or the belly, which is getting quite fat right now? With I believe the 5-year Treasury yield is the highest yield on the entire yield curve, which according to Michael Howell, who did an interview with Joseph and myself that aired this morning that people should definitely check out, is not a good sign.
No, it's not time to buy bonds. And this is a guy who has generally been on the bull side since I started running money, basically. So you buy bonds when there are 2 or 3 of these circumstances possibly together. A, the economic growth impulse is slowing down. B, inflation and inflation expectations are slowing down. And again, I'm talking about the rate of change. We don't need to be in a recession. We don't need to have deflation. We need things to slow down. So the pace of change should slow down, either of inflation, realized inflation expectation, or growth, real growth. And the other is when the Federal Reserve is telling you to buy bonds, which means they're providing you with what I call a free carry optionality, which means that as long as you buy the bonds before they do or while they do, together with them, you effectively are ensured to carry back to par, or to make sure that you clip the coupons basically almost for free. So let me think, where do we stand now? The rate of economic growth has been slowing down on a rate of change basis, again, since basically 1 year. So we reached the peak of the economic growth impulse about 6 months later. The biggest fiscal stimulus was released in the US, which is not, of course, not a coincidence. And then you start to have a bit of a fiscal cliff, a bit of a fiscal drag, and then you slow down. And that's what we have seen, right? So from that perspective, buying bonds historically would have been a decent choice. The problem was that inflation in the meantime was picking up, and the momentum of inflation, Jack, was picking up too. I put a chart on the Macro Compass. It's my newsletter, my free newsletter, that shows that the central bank's reaction function, and Joseph can tell us more about that. People think of it as a linear relationship. So inflation or inflation expectation goes up and they will tighten a bit. Inflation expectations go down and they will ease a bit. The reality, in my experience, is that this will be true when we are in a certain status quo controllable regime where inflation is between 1 and 2.5 to 3%. And then they will simply move in a linear fashion. But when inflation expectations are 3.5% and realized inflation in the US has been 7% over the last 12 months on average, 7%, guys. When you reach these boundaries of their controllable status quo, their reaction tends to be more than linear. They have to put themselves, as it said in the bond market, ahead of the curve, or they need to try.
Is this it?
Yes, this is the chart. So you see on the x-axis, inflation and medium-term inflation expectations. And on the y-axis, that's the reaction function of the central bank. When you are between the red vertical lines, so inflation between 1 and 3%, let's say, if inflation is 1% and it's moving up, let's say between 2 and 3%, they will tend to tighten. You see the linear reaction function. It's a linear line, linear blue line. The more inflation is higher, the more they will tighten, and vice versa. But it's a linear reaction. Now we are extremely close to the right-hand side, or actually we crossed the right-hand side, where inflation has been 7% for 12 months. Their reaction function, the blue line, will be non-linear. It will be convex. They will tighten much more linearly than normal. And why? Because they need to bring things back into those red boxes there, into these red lines. They need to regain credibility. Credibility is the strongest asset of a central bank. It's not QE, it's not rates, it's credibility first and foremost. If they don't have that, Jack, there is nothing they can do that will make any sense. You can see that in Europe, where they have been losing credibility, and now they're telling us they will backstop Italy and other weaker governments, and the market is just not believing them. So they will have to try and do something to bring back the market perceptions into those red lines. And so this is not an environment where you have to buy bonds, because they will do more than necessary even. They will have to be even more aggressive to bring things back. and that is not a moment where you buy bonds. The third will be when they tell you explicitly to buy bonds, and Joseph can tell us more, but they're telling us to do the exact opposite via quantitative tightening. They will supply bonds to absorb to the private sector. And at the same time, they will reduce the reserves that banks own as well, which are one outlet under which they can recycle these reserves from a regulatory friendly liquidity asset, which is the bank reserve, to bonds. Now, with QT, the Federal Reserve has been taking away these reserves from them and giving them more bonds to absorb, which obviously has to have a different marginal yield at that point. So I don't see any reason why I should buy bonds at this stage.
Joseph, what do you think of Alf's chart?
I was just going to say that's a really good chart. Just so you guys know, Alf's chart is spot on, right? So the Fed usually was doing 25 basis points. Now it's doing 50, right? It's becoming, and there's whispers, and I think they might even do 75 in the future. So again, it's moving non-linearly. It's going higher and higher. I would ask Alf, do you think that the ECB will get the memo and maybe start doing something? Maybe you need to send them this chart.
I think they